I'm Mark Rinn. I am Senior Vice President at Converse County Bank, Operations Officer. My role here, unfortunately, is having to have dealt with several different embezzlement cases in our community. So that's where my experience comes in, dealing with these situations. And we're here to help your organization try to implement better controls and procedures to help prevent this in the future.
My name is Mike Marceau, also a Senior Vice President here at Converse County Bank. I'm in charge of risk management and been here the same amount of time as Mark, about 15 years. Before starting with Converse County Bank, I was a CPA for about 5 years. Some of the duties that I perform here at Converse County Bank, and one of the reasons that I present these with Mark is I have to review our policies and procedures, internal controls, financial statements, and make sure that we don't have any holes in the way that we do things, make sure that we can prevent embezzlement and fraud here at Converse County Bank. Today we're making this presentation to help protect you guys from fraud and embezzlement in your day-to-day operations. For a little bit of background, every year about 2/3 of small businesses and nonprofits fall victim to some level of fraud. That could be a few $100s, few $1,000s to several $100,000 and even millions of dollars. In the past 4 or 5 years, just in our community with nonprofits, we've ourselves found out about 4 or 5 embezzlement/fraud instances. And as we'll talk about later, those are just the ones that we've found out about. Most of these go unreported, and even more of those undetected for several years. Typical nonprofit loses between 5% and 7% of revenues annually as a result of fraud. That's not every nonprofit every year, but across the nation, fraud accounts for losing 5 to 7% of revenues annually. The types of fraud that can be perpetrated can either be internally or externally. Today we're focused more on fraud and embezzlement that occurs internally, but it's also important to be aware of fraud that can happen externally, and that's generally from a third-party provider, some sort of relationship that you have with a third party. The vast majority of internal fraud, which is what we're focused on today, is committed by longtime trusted employees. I would say 95 to 100% of the time that we get involved, the first thing that we hear is, never would have expected it. The guy or girl has worked for us for a long time, 15, 20 years. They've always done a good job. They've always been honest. Never would have suspected it. And that makes sense. If it was someone that was new, someone that you didn't trust, you'd probably be paying more attention. When you get comfortable with someone, begin to trust them, then you don't pay as much attention, and that's when things can fall through the cracks. Just like the prior bullet, most internal fraud is a result of lax internal controls, a lack of segregation of duties, and I would say most of the time, neither of those. There's big holes in internal controls, and there's not a segregation of duties. You're having one employee perform multiple duties, so there's not the checks and balances that are necessary to detect and prevent fraud and embezzlement.
Okay, so one of the first things we're going to talk about, as Mike mentioned, is the internal fraud. Most common internal fraud that we see is going to be embezzlement. The interesting thing that most people don't realize, when they think of embezzlement, they think of someone taking money from an organization or a business. Embezzlement can be as simple as someone, stealing cleaning supplies, or someone taking the company credit card to buy their own personal groceries when they go to get some stuff for the business or organization. So what embezzlement is it's the theft by employees or other trusted partners of the business. Most embezzlement involves theft or diversion of company funds to the employees. Embezzlement can happen in any department of the organization. Like I said, it could be as simple as cleaning supplies. It could be, someone taking toilet paper. It's, this time in our lives, toilet paper is very valuable. So, that's one of those things that, people tend to take. Typically it happens where either cash is handled, the books are handled, or supplies are handled.
One of the primary focuses we're going to talk about today is spotting employee fraud and embezzlement. Most employees or trusted partners who commit fraud or embezzlement, they exhibit telltale signs. And that's something that's important to pay attention to. In a large percentage of these situations that we find out about, you'll see the employee committing the fraud living beyond their means. A lot of times they're struggling with financial difficulties. They may have an unusually close relationship with vendors, or they have, they exhibit excessive control issues. They might not want anyone else to do their job duties. They might not never take a vacation, because if they do, they're afraid if someone else does their job for a week or two, they'll find out that something doesn't look right. Some of the warning signs that we recommend looking out for are, employees that are afraid to take vacation. Here at our bank, we require that employees take at least 1 week consecutive and have someone else being able to perform their function while they're gone, just as a precaution to make sure that, if there was something going on, someone else might be able to catch that. If you see employees that continually work overtime, even when they're not required to do so, that's another red flag. A lot of times when these embezzlement or fraud situations occur, they don't do it during the day. They're doing this stuff at night, in the morning, when people aren't around on weekends. And we tell people, just because someone continually works overtime or works extra, it's not necessarily a bad sign. Everyone would like employees that do that, but if there's other red flags, that might be something to pay attention to. Another warning sign is employees who regularly take work home with them. Like the bullet point before, a lot of this fraud occurs when there's not eyes watching them. And employees that live beyond their means, when we hire someone here at the bank, we make sure that we pull a credit report. People that are struggling, that gives them a reason in their mind to justify why they should be entitled to committing this fraud. Same thing with employee living beyond their means. We'll see employees that work for these nonprofits or small businesses. They feel like they should be making more money, and so in their mind, they can justify that they're embezzling. They're basically just taking money or supplies that should be theirs, that they're entitled to. Yeah, so when an employee's living beyond their means, what we'll see sometimes is they'll be taking expensive vacations. They'll drive a vehicle, or they'll have multiple vehicles that you wouldn't necessarily think that they would be able to afford based on the salary that them and their spouse earn. They may have a second home, but generally it's things that you'd be able to notice. It's vehicles, it's vacations, it's homes, and a lot of times it's shocking, but a lot of times they're bragging about the vacations they're taking. They're bragging about showing off the vehicles that they were able to buy. So, they almost can't hide it. And what we like to stress when we do these presentations is almost every time, unless it's a repeat offender that's just a bad seed, it starts small and it grows to beyond where they where they can control it. An example is an employee might be short on cash 1 month, and so they tell themselves, you know what, there's an extra petty cash here, I need $200 to pay a utility bill or something. They take the $200 because they're aware of a internal control that isn't tight, no one's going to notice it at least for a month. They intend to pay that $200 back. It comes to the next month, no one has said anything, no one noticed, and they're kind of in the same situation. So they do it again, and it generally gets to the point where the employee either gets used to the lifestyle or they're in a bad spot financially and they can't pay it back. So they continue to perpetrate this fraud to cover up what they've been doing and also, continue their lifestyle that they've become accustomed to. But 90% of the time we see this, they're not bad people. They got into a bad spot and then they got in over their head. And they got to continue perpetrating the fraud, or else someone's going to find out and they fear the repercussions. Yeah, it's especially important right now when there are a lot of people working remotely to pay attention to some of these warning signs and make sure that we have strong internal controls in place, strong checks and balances, segregation of duties, and we'll talk about that a little bit later. But when they're working from home, some of the stuff that they take home, it'd be accounts receivable. If they're taking home the deposits, and they're going to say that they'll make them on their own time. If they're, doing the accounts payable or payroll, it's generally going to have to do with accounting. It's any of the accounting work is probably what they're going to take home, and a lot of times, like Mark alluded to earlier, it'll have to do with checks going out to fake vendors or money coming in, especially cash. That's generally what we see when they're taking work home.
Yeah, so as Mike alluded, to a lot of the different things that could potentially happen there, some of the things we want to talk about are what are ways to protect your business or your organization from things like this happening. One of the things we get from a lot of customers is they're really nervous about technology. They're nervous about using a debit or a credit card. They're nervous about using a cell phone to deposit a check. They're nervous about those things. You get a lot of the old school, I'd much rather deal in cash. Cash is safer, I know it's good. Where that actually brings you up to a lot more risk. One thing technology does is it gives you a footprint for every transaction. And so with that footprint, you may not see it on your statement, but there's a way to track and identify the transaction of what happened, where it went, who it went to, a lot easier than it is to deal in cash. As an example, let's just say a donation box. You get a box full of cash. Typically, that's the way people make donations. That cash is really hard to track. If a little of that cash leaves the box, chances are nobody's going to notice. So in situations like that, dual control is really important. So that cash box is locked, maybe with 2 padlocks. And so you have 2 people having to get into that, so that way, not one person can pilfer money off of the box before anyone notices.
And the same thing with checks.
Mm-hmm.
One of the fraud cases that we saw, there were checks coming into a nonprofit. There weren't segregation of duties set up properly. Internal controls weren't tight enough, and the person that was in charge of collecting those checks and cashing them, set up a similar sounding nonprofit checking account at another bank. They would deposit those in there. So when the donor sees the check come back on their bank statement, they see that it was cashed, nothing was changed on the check, but what they don't realize is that it was deposited in another account with a similar sounding name, so the bank that it was deposited in didn't notice anything different, that it looked legit to them. So, it's leveraging technology is very important, and it does provide a lot of strong internal controls, especially an audit trail, and it's not something to be afraid of. It's actually something to be embraced, especially with the tools that are available now from banks like ours and all banks. All the banks have the same type of technology. It's becoming more and more common, and the audit trail and the footprint, like Mark said, it makes it a lot easier to track anything that looks suspicious.
Yeah, and anymore today, the technology is out there for organizations to utilize. Things like accepting debit and credit cards. It's really difficult for an employee to embezzle those means because it all happens automatically. So when someone makes a donation through a debit or credit card, that employee can't redirect those funds
without an audit trail, without being detected.
Yeah, and so there are ways for them to do it, and that's where controls come into play a lot as well. A lot of these things aren't going to 100% protect you from someone stealing. If someone wants to steal from you, they're going to find a way to do it. What you have to have in place are the ways to identify it quickly to prevent the large dollar amounts, and being able to prove that. With technology, you go down, using debit and credit cards as an example, using direct deposit as an example, minimizing the amount of cash and checks. Every single embezzlement case that I've dealt with, they're able to prove a dollar amount, but that dollar amount is never the total dollar amount that was actually embezzled. Because when you're talking cash, it's just so difficult to identify where that cash really went or what was actually embezzled. So I would think that even though some of these technologies cost a little bit, the amount that it saves you in the long run, it's worth the expense. Just because, like I said, you have a $100,000 embezzlement case. Did they steal $100,000? No, they probably actually stole $150,000. So if you lose a couple of percentages on each transaction, it never adds up to the total amount that could.
The internal controls weren't in place, and so the employee was falsely accused. And when you have strong internal controls in place, good segregation of duties, that protects the employees as much as it protects the organization. And that's what we try to stress to the boards we talk to. It's not only for the protection of the board members, it's not only for the protection of the donors, it's not only for the protection of the government funds that are coming in or the grant fund, but it's also for the employees.
A lot of times when organizations set up these type of procedures, it's perceived as hurdles, right? It's perceived as, I've now got to do this additional work, where you want that perception to be, this is in place to protect myself. As an example, I was involved in one embezzlement case a while back, and so when they start going through all of this information, they're going through years worth of information. And when you start dealing with things back 2, 3, 4 years ago, when there wasn't a segregation of duties, the questions start to arise. Okay, why did you do this? 4 years ago, the employee who did the transaction was like, I don't remember. That's one of the challenges, because going back 4 years, why did you write this check to petty cash? They're not going to remember that. Now, you got good segregation of duties where you've got multiple people involved in it, then it's a very easy, nothing invalid happened because there was these procedures in place. The person getting the cash wasn't the person that signed the check. So those things protect everybody involved.
One of the recommendations we make to boards is to reconcile regularly. Someone outside of the accounting or bookkeeping function, preferably the CEO or executive director, should review the financial records on a regular basis and be familiar with what they're looking at. This includes bank accounts, accounts receivable, accounts payable, credit card statements. The reconciliations for all bank accounts should be prepared and reviewed by someone, either the CEO and executive director or board of directors, at least monthly. If you don't have reconciled bank accounts with invoices attached to it, that's when things can fall through the crack. Like Mark said, why'd you make that $400 purchase at Walmart? Why'd you take that trip to Jackson? There's probably a legit reason for it, but without the proper documentation and backup, it's tough to prove, and people's memory fades. And a lot of these embezzlement cases that we see, they're going back looking 3, 4, 5, 6 years to try and find out when it began. And so having those controls in place and making sure someone is reviewing the work prepared by the accounting and bookkeeping function, whether that's an internal accountant or external accountant, it's paramount. Generally, we see small businesses and nonprofits using, either Quicken or QuickBooks. Mm-hmm. And QuickBooks is a great accounting software because it's very flexible. You can make it work for whatever type of small business or nonprofit you're operating. Problem is, you can make adjustments very easily, sometimes after the fact. You can create checks, and afterwards you can change the payee on the check. There's a lot of issues with QuickBooks, and so that's why it's important that when we talk about reconciliations, it's important for the board of directors and the CEO or the executive director to request the bank statement from the bank, along with copies, pictures of the actual checks that were deposited, and then invoices or supporting documentation behind it. That way, you can see what check was actually deposited or cashed at the bank. We've seen instances where boards would ask for copies of the checks. They would give them copies of the checks from QuickBooks, and it wouldn't match the actual check that was deposited. But the board or executive director weren't provided actual pictures of the checks that were deposited in the bank, and so to them, it looked legit. They weren't aware, until much later.
As an example, what Mike's talking about is, they would write a check through QuickBooks to themselves for $500, and then would go back and edit the entry in QuickBooks and change it to Rocky Mountain Power. So when the board got the actual report from QuickBooks, it looks like the organization paid Rocky Mountain Power, where in actuality the check went to an individual.
Yeah, and we've seen the same thing where, and I believe it was Rocky Mountain Power, where they said, the invoice came in, it was messed up this month, so we had to, do 2 checks. We had to do one for the X portion of the building, and then they screwed up, so we had to make another payment to them. So the total dollar amount didn't seem all that weird, but you can easily get away with an extra $100, $200 a month doing stuff like that, and that's why it's important to have the bank statements, copies of the checks, and invoices to go with that.
Yep, and same thing with credit and debit cards. Where we talked about embezzlement, where some of the cases we see is, you send an employee to the grocery store to get, napkins and paper plates, and they go and they buy napkins, paper plates, and then a 12-pack of soda for their family, or, some additional items for themselves. So we see a lot of times where when the people are making those purchases, goes to the credit card, they're reviewing the credit card bill, and they say, oh, yep, we did send them to Safeway that day to make those purchases. So that it just slides through. They're not reviewing the actual receipt of the purchases that were made. And so one of the recommendations that we make to those organizations is, hey, you should probably be getting a copy of that receipt and reviewing what was actually purchased to make sure it lines up with what was said was purchased.